Well, good afternoon, everybody. We're going to talk about the joy of tax. And have a very interesting panel here for you today. I'll let them each introduce themselves very briefly so that you know where they're coming from. And we've got some diverse backgrounds there, so we're coming at this from a number of different angles. Start with Mike.
Thank you, Ed. I appreciate it. My name is Michael Kosnitzky. I'm with the law firm of Pillsbury, Winthrop, Shaw Pittman. My practice is representing the rich and the spoiled. The first is mandatory, the latter is optional. I practice in New York City, Washington, D.C., Los Angeles, San Francisco, London, and Miami, and I'll give you one guess where my tax residency is. You got it. Good guess. It's a smart group. Go ahead.
Jim.
My name is Jim Simpson. I'm with First Republic Bank. I grew up in the tax business and the leveraged lease business with the commercial airlines many years ago. The clients that we have now are high net worth individuals, very high net worth individuals, and tax always plays a big portion of what they're doing with the airplanes.
I'm Nell Stubbs. I'm with Conklin and Decker, a JSSI company. I've been doing tax on aircraft since 1988. I think I'm getting it pretty good at it now. And I work with all 50 states. I do track all the legislation activity going on in the 50 states relative to taxes on aircraft. So it's very specific, just aircraft.
I'm Jeff Towers with TVPX. We've historically been a 1031 exchange company focused on aircraft, which has become much less fun than it used to be with the tax law change. Fortunate to have worked with Ed and Nell for many years now on the NBA's tax committee. Our companies also include an owner trust company that's based in Salt Lake City and some new companies that are just coming on, including the customs brokerage company.
All right, so when I got the invitation from CJI to moderate this panel, I have to admit I kind of misheard what they said. And I said, the joy of what? And I started really saying, well, hey, CJI, they're innovative, they're point of the spear, we're expecting different out-of-the-box thinking from them all the time. So maybe they really do want to do the joy of that other thing. So I started doing my PowerPoint presentation and got into it, and then I had this Emily Latella moment where I said, well, wait a minute, never mind, I didn't have time to change all the slides. So if you bear with us, I was able to modify most of them, but they're kind of geared for a little different story. So with that, we will start The Joy of Tax, a gourmet guide to aircraft ownership. We hope you bear with us. We're going to start out, most of you know what the Tax Act was all about and the different changes of it. So what we've asked is for Mike to give us an example to kind of bring all those different phases of the Tax Act and put them into perspective.
Well, thank you, Ed. I'll do my best. Love the slides. Let me also thank Corporate Jet Investor for those delicious gluten-free, sugar-free churros that we had during the break. They were terrific. And Money, you're asking what I'm wearing. I'm wearing a guayabera, which is worn in Latin America, in Miami in particular. So I don't want anyone to think I'm being disrespectful, not dressing up. It's tantamount to having a suit in those countries. So that's why I dressed the way today. I even brought a Cuban cigar with me, just in case. So let me just get a couple of preliminary points. First is that there were changes in the law that went into effect at the end of last year for 2018. Some of those changes, by the way, came into effect prior to 2018. For example, if you bought a plane the end of last year and expensed it, you could carry that loss back. So people that were aggressively looking at these changes early had some benefits that those who proceeded in doing purchases and other things in 2018 would not have, because carrybacks are not permitted anymore starting in 2018 of losses. You could have done that in 2017. It's important to have a holistic approach to this stuff because you have these tax law changes, but there are other things that impact it. For example, there's existing law that hasn't changed. You've heard about being able to write off 100% of an airplane, new or used. That's true. But number one, it has to be used 100% for business. Can't have any non-business use, or you'll have to prorate. But part of that is determining whether or not entertainment or commuting is permissible. It is no longer permissible. The definitions of entertainment, using plane for entertainment or commuting, haven't changed. Those rules are the same. There's no new gloss on those rules. So you have to first define whether or not they fall into one of those categories or not. That's old law. In addition, there's case law that has impacted the plane ownership. The recent lender case, while not changing so much of the planning, gives more gloss and a roadmap to how family offices structure their plane ownership so that they can engage in a trade or business by managing other family members' money. And so that, along with, of course, sales and use tax that my colleagues will speak about, I'm sure, excise tax and other areas of law, all impact the structuring. So let me give you an example. And I'll get to the plane ownership, but I got to give you the preliminary stuff first. And I'll try to weave in everything that's important that you need to know in the example, and we'll use it as kind of a baseline for going forward. Consider a wealthy individual who also collects art. And in the olden days, meaning 2017 and prior, that investor, that owner of and collector of art, would buy and sell art, and the sale, they could do a like-kind exchange. Back in the day, no longer like-kind exchanges are no longer permitted. That's no longer the rule for art and airplanes, but they could do a like-kind exchange when they sold art and avoid the gain. Or if that worse, they pay tax on the gain at effectively 32%. That was a 28% capital gains tax and a 3.8% net investment income tax, all in about 32%. So if an investor of art sold artwork for $100 million, he or she would pay tax of about $32 million. Remember these numbers. But in addition, in the olden days, they could deduct all of their itemized deductions, all of their other expenses associated with the art ownership. That would include plane ownership. Many of those expenses were deducted, both depreciation and operating expenses, as part of the ownership of the going to and from family offices. That was permitted. That has all changed starting in 2018. There are no more like-kind exchanges, and while the capital gain rates remain the same, still effectively 32%, those itemized deductions for security, for plane, for insurance, and anything else relating to that is no longer deductible. So fast forward. How do we put someone in the same position as they would have been before, or better? And the answer is that you would try to migrate that person into being in a trade or business of being an art dealer, or, under the lender case, in the trade or business of managing other people's money. If you're able to do that, then you still fall within the cubbyhole of what's called Section 162 and can deduct these expenses. Very important. Now follow the numbers on this one. Very, very important. Let's go back to my example with the $100 million of gain. Previously taxed at 32% effectively, and now no deductions permitted. If instead you operate that activity through a flow-through entity, let's just say a partnership or an LLC, properly structured, or an S corporation, and you pay yourself a $30 million salary. I'll come back to why I use $30 million in a second. That $30 million is taxed at the highest rate now, 37%. That $30 million times 37% is $11 million. Let's remember the $11 million. The other $70 million, if we play our cards right, is taxed at 29.6%. And I'll explain that in a second too. 29.6 times 70 million is 21 million. 21 million plus 11 million is back to our 32 million. We have the exact same tax rate as we had before with capital gains. The difference is, since we're in a trade or business, we can now deduct all of our expenses that we couldn't before. The reason for the 30 million is, in order to take the deduction that gets you to the 29.6% rate, that's under what's called qualified business income rule. That says that you get a 20% deduction on your qualified business income. That's 70 million, if it's properly structured, qualifies as that. So in effect, how I get to the 29.6 is you get a 20% deduction of the 70, that's 14 million. 70 minus 14 is 56 million. 56 million times 37% gets you your $21 million that gets that benefit. But that benefit only applies if you paid at least one of the exceptions, one of the rules is that you have to pay out at least twice that in salary to yourselves and others. So 14 million deduction, we paid out 30 million in salary. 2 times 14 is 28. It's less than 30 million. You get the full benefit. So you get, the point of the exercise is by migrating someone into a trade or business, they can now deduct the plane expenses that would otherwise not be fully deductible under the new law, and end up in the same basic rate, either because of managing other people's money or, in my example, simplistic example, being in the art business, migrating to the art business. We'll talk about more how you do that and how you qualify under lender shortly. To close the loop on this, when you buy the plane, and we'll talk about how you have to do that, when you buy the plane, you buy your new airplane or used airplane, and it's used only for business. Unlike if you do not restructure, that full purchase price, if it's done properly, can offset the 100 million in my example. And so that's the benefit of looking at the restructuring and doing it properly. There are other limitations relating to interest expense that we'll hopefully cover shortly as well. But that overview, and we'll come back to it, covers really the bulk of the changes that have occurred during the last year. Thanks, Ed.
So, Jeff, you've been historically a big player in the 1031 exchange side of the business, and there's a lot of talk about how bonus depreciation, with 100% bonus depreciation, that was kind of the give back for taking the 1031s away. But it's not quite that simple. Could you talk a little bit about how the Tax Act has the give and take associated with bonus depreciation in 1031s?
Sure. So up until the end of last year, there were really 2 income tax structuring cards that were regularly used with the aircraft transactions. One was 1031 exchange, which was a way to defer the taxable gain that arises anytime that you sell a depreciated piece of property like an aircraft. Very simple math. If you sold a $10 million aircraft and it was fully depreciated, that means that you had $10 million of ordinary income that you had to pay tax on in the year of the sale. If you did a 1031 exchange, then there was a way to defer that taxable gain. Over the course of the 2000s, on and off, but certainly since the recession kicked in, there was an additional incentive for purchase of newly manufactured equipment like airplanes. There were rules, and we'll talk about those rules in a little while, but the point is that that was an additional incentive to encourage things like manufacturing and just spur the economy. So the 2 pieces, the 1031 exchange to defer the old tax and the bonus depreciation, which related to the new purchase, all fit together pretty well, and certainly if somebody had the opportunity to use them both, that happened very, very regularly. Now the rules have changed. No longer is there the ability to do a 1031 exchange, at least at the federal level, because of the change in the tax law. So we're looking now at, well, how does somebody handle the taxable gain that still happens when you sell depreciated property? Again, the $10 million sale of a fully depreciated aircraft, that's $10 million worth of taxable income. And there's sort of pros and cons to the new regime, and I call it the new regime. By that I mean that's the only game that we have now is the 100% expensing. Certainly, as Ed indicated, the increase in the amount from 50% bonus depreciation that we were used to up through last year up to 100% probably was assumed to be a way to take the place of a 1031 exchange. But the rules were and still are different, so you need to be mindful of that. The benefits of 100% expensing, and there certainly are some, is if somebody can really benefit from the 100% expensing, in other words, if they qualify for that benefit, then they are getting an immediate boost in terms of having this big fat deduction that they can take on their income tax return for the year that they acquire that new property. That's more attractive if you qualify than a 1031 exchange would be in many respects, because 1031 exchange is just sort of kicking the can down the road as far as when you have to deal with that taxable income. There's no like-kind requirements for bonus depreciation. You really don't even need to sell anything to be able to benefit from bonus depreciation. There's no third party that you have to hire, no qualified intermediary, no 1031 exchange documents with the magic 1031 language in them. You don't need to worry about any of that stuff. So there are clearly some advantages of 100% expensing, and it certainly got some people very interested in making aircraft purchases. Again, aircraft that can be used for 100% expensing no longer are just newly manufactured equipment, but it also includes used equipment. On the con side of things, again, comparing the way things were last year with this year, there's a couple of things that you need to keep in mind. One is, maybe this isn't going to apply to many people, but it will to some. You were able to do like-kind exchanges for property that didn't qualify as maker's property. Maker's is a depreciation schedule that is very commonly used for Part 91 aircraft. The reason that might come into play is if somebody had an aircraft that's predominantly used outside the United States, they could exchange that aircraft for another aircraft that's predominantly used outside the United States. That was perfectly acceptable as a like-kind exchange. These days you can't do that because to qualify for makers, the aircraft has to be predominantly used in the United States, and it has to be predominantly used for business purposes. And the business purpose thing is a little trickier than it sounds. So there's that little restriction. A couple of the other things that are important to remember is bonus depreciation is scheduled to disappear. It will start phasing out in 2023. And there'll be 20% reduction, so 100% goes to 80% to 60-40, and eventually down to zero over the 2003, over the next 5 years. So we're going to get into a period, maybe a year or 2 years from now, when people are going to say, well, I'm going to plan out my next 5 years, my next aircraft purchase, and there'll be a little head scratching about, well, how do we do that? We don't really know what the rules are going to be, or the rules as they currently exist kind of make it look like maybe we want to hold on to our existing aircraft for a while so we don't have to pay the tax on that, because there won't be an offsetting deduction. And the offsetting deduction, that's really the regime that you have now. If you sell an old airplane, you need to be thinking of how can I avoid having to recognize that gain, or how can I avoid having to pay tax on that? And the answer is, well, if you buy a new piece of equipment, then you can offset the gain. In the olden days with 1031 exchanges, you could tie those transactions together even if they crossed over tax years. Now it's a little different. A seller and a buyer may have very different tax strategies as far as this a transaction that they're going to be engaged in. The buyer is saying, boy, I'd really like to close on this aircraft at the end of this tax year and make sure that I get the benefit in this tax year of that 100% bonus depreciation deduction. A seller might be saying, hey, wait a minute. If I sell my aircraft in December and I'm taking delivery of a new aircraft next April, I'm going to get whacked for tax this tax year, and I'm not going to get a deduction until next year. And so people are going to have to start thinking ahead. There's certainly ways to address these kinds of issues, but it's a different world as far as that kind of tax planning than it used to be. So those are probably the main differences, I would say, between the way things were last year and the way things were this year. One other thing to keep in mind is the federal tax law changed, but in most states you also pay income tax. So some states are going to adopt the federal rules, and they do that pretty automatically. Other states still have 1031 exchanges for income tax purposes. You sort of have to pay attention to what states you need to pay income tax in, and then figure out whether you still have the ability to defer the tax at the income tax level.
Just
at the state tax level. I'm sorry.
Just a quick one, Jeff. Two quick points or gloss to that. My advice to clients is buy more expensive planes and buy them sooner. Because while it is going away and starting to phase out in 2023, we saw a 38-seat swing in the House. We see a very close Senate. We have a president that, whether you like him or not, is erratic. We don't know what he's going to trade off on. Tax law changes can come sooner than we think. So I've been telling clients you should budget the next 2 years to buy your plane. And then to your point, just to put an exclamation point on your point, good point, is that the calculus is the value of the trade-in plus the buy-up. Is that tax benefit going to offset the gain that you no longer can defer because of like-kind exchange? That is going to be taxed, but because of the shelter, the deduction from the trade-in portion and the uptick that you buy for a more expensive plane, you have to do that analysis to see whether you have the offset. Thank you.
Yeah, let's move on and talk a little bit about the current state of the market. We've had a lot of different panelists up here over the last couple of days talking about, where the market is. I think everybody's in agreement that we've got a relatively hot market, much more of a seller's market than we've had before. I'd like to get Jim and Nell's view on, do we feel that this is a result of the tax changes? Is this the economy? Where is this frothing that we're seeing coming from?
Well, I'm the naysayer up here. I don't think everybody wants 100% bonus depreciation. I also know that most people can't take 100% write-off in 1 year. And so, this might be a boon for the people who can, but there's a lot of people out there who can't. The aircraft has to be ordinary and necessary to the business of the company. The aircraft has to be used greater than 50% for business, not only in the year that you take delivery, place the aircraft in service, but you have to maintain that greater than 50% business use for the subsequent years. So, and one more thing, I know how much everybody loves to go under audit, but you take an aircraft, you write off 100% in 1 year, you're going to be visited. They're going to come and make sure that that aircraft is ordinary and necessary. They're going to come in and make sure that it's being used greater than 50% for business. They're going to look at every single piece of paper. If you don't have it, you have no defense. So that's pretty much my position on it. Just, be careful when you think about 100%. We also, though, have a lot of people who buy aircraft that are less than 10 million, less than 5 million, less than 2 million. Those people can use the Section 179 deduction. And that doesn't have to be taken all in 1 year. That can be spread out over a couple of years. So look at all the different things that are available to you. And even though I think 100% bonus depreciation has certainly got a lot of people's attention, at the end of the day, the CFOs are driving the ship now and not the CEO. And they're going to say, I think we need to be a little bit more conservative on this.
This is a terrific point and overlooked. There's a lot of hype on that deduction. If you can't use it, it's going to carry forward. It may be worse for you than taking the straight line. One of the things, that's why I mentioned in the very beginning, this kind of holistic approach. You got to understand, Wayne Gretzky used to say, it's not where the puck is, it's I know where the puck is going. You got to know where the puck is going. And part of that is, to your point, which is an excellent one, is that if you don't have enough income, let's say your family office only has passive income, dividends, interest, capital gains, you can only use $250 per single person, $500,000 per married couple against it. So if you buy a $40 million plane, a $65 million plane, you can only use $500,000. So you have to create earned income in your office. You have to have business income to offset it, which means, again, back to the lender case, taking income out in a way that's like an investment management type income. Terrific point, though.
Jim, what are your customers saying?
Exactly that. Look, we don't have the passive income to offset the passive losses by using the expensing method, so it doesn't work. It's also, I was down in Dallas for the NBA tax meeting in May, and Shelley and I were down there listening to the tax experts go back and forth on this thing, and they're saying this is a huge risk of audit if you're going to take an aggressive position and write it off in 1 year. So most of our clients, and we don't give tax advice, we ask what they're thinking about, and they say, I'm either going straight line to be really conservative, or if it's going to be in a 135 operation, I'll do 7-year makers, and that's it. But conservative is better.
You guys are killing my after sale. No, I mean, I'm trying to, I certainly raise these issues, but with my clients, I'm trying to structure to be able to use it. And for example, if you have $1 billion under management or more, and you're able to take an investment management fee into a separate entity that owns the aircraft, then that's earned income that you can offset it. But your points are both well taken. It's not one size fits all. The point is that you either got to look at it, it's not goody-goody, we got to write off, big write-off, because you may not use it and it's worse to carry it forward, or you have to pre-structure. And the last point on that is, you can't wait to restructure most of this stuff after the end of the year. Most of us have been working with clients since last December in doing these restructurings or making a determination whether we have to live with a different type of write-off. But we've been doing this for a long time, not now, but you have a few weeks to clean it up. You can make some changes up till the due date of the return on partnerships, unextended due late, but most of the stuff has to be embedded sooner than later.
Well, we're starting to segue into the challenges of bonus depreciation, or BD, and Nell talked about some of them. We're talking about audits and going from, crossing years, and maybe talk a little bit about what are some of the particular issues that are making it so challenging for people to actually utilize bonus depreciation.
Well, from the high net worth space that I see, we have clients now buying airplanes, and they're not even considering the tax implications. They want the airplane. It's their lifestyle decision. If their tax advisor can get something out of the airplane in the form of tax benefits, that's great. But it's not first and foremost in their mind. It's how fast is the Wi-Fi, how far can the plane fly, and how many people can I seat?
What about the fallacy of once you take bonus depreciation in year one, you've gotten all the depreciation, and you never have to worry about depreciation as an issue ever again?
Well, that's the biggest fallacy in the world. I mean, of course you have to worry about it. I mean, some of the questions here, if you expense a jet in 2018, can you do a sale leaseback 2 years later? Well, I'm guessing there's going to be recapture on what you took as a deduction.
You have to keep 50% business use going forward, but there's a preliminary test. You cannot, this is a trap for the unwary. This is one of those, put an exclamation point or a star next to on your notes, is that you have to maintain 50% business use. But if you lease to a related party, that leasing is more than 25%. I'm sorry, to a related party is more than 25%, then you don't count any of that as business days towards your 50%. So it's a trap for the unwary. How you get around that, by the way, is you're leasing from a disregarded entity. In other words, again, without getting too much in the weeds, you usually have a family office up here, like in the form of a partnership, and then you have ownership below that entity, and then you lease to. You do a lease to a disregarded entity. For tax purposes, all of that doesn't count. It's still treated as if it's owned by the flip, by the family limited partnership. So it avoids that lease problem. But my colleagues are exactly right. You got to monitor it ongoing. And the issue of what is entertaining, not entertaining, commuting, not commuting, I guess one of the big takeaways is if you are going to do this deduction in the first year, you have to make sure, what I tell clients to do, buy it at the end of the year, use it once or twice for business, exclusively, clearly unambiguous business. Do not use it for personal use at all, even in no close calls, and then put it on the shelf until January because it's a snapshot this year. Going forward, if you foot fault or there's a percentage, then you're dealing with operating expenses. But in the first year, that goes to the 100% write-off. And again, the other, besides the recapture being a big issue and monitoring it, and making sure that you have no business use, in particular in the first year, buying it at the end of the year, using it only for business. In fact, I have clients that are leasing aircraft for the holidays. They're leasing using other people's planes to avoid using their own plane, so they have the full write-off. Is the point that was made earlier, that you can structure your family office to try to throw off family earned income. Not dividends and interest. In other words, if your family limited partnership pays out salary or a management fee that is earned income. That can be used to offset the purchase of the plane. You have to have enough. You have to have enough earned income in a reasonable way to manage those assets. But that's what the lender case is about. And so I'm optimistic that some of those things are going to pass muster under audit. I'm not afraid of an audit. My clients get audited all the time. But yes, you have to raise with the client appropriately. There is a risk of audit, no question about it.
I'd like to bring up another gotcha: passive losses. So if you're going to buy that aircraft and lease it back to a charter company exclusively to be used under Part 135, even for the owner, you've now turned your depreciation from active to passive, and you need passive income to offset those passive losses generated by the depreciation. So it may sound great to go out there and buy an airplane and lease it back to a charter company, but if they're going to have exclusive control of the aircraft, you're not materially participating in the operation of that asset. You're not going to have, there's not a whole lot of passive income to have out there. So be careful. These are the gotchas. Yeah, it sounds great, but it doesn't fit everybody.
Yeah, absolutely. That's one of the reasons you got to be careful of using disregarded entities in your structure. You might want to have a lease for one purpose, but you want it not to count for tax purposes. If you have a LLC underneath your entity, even though there's a lease, that lease is not recognized for tax purposes. It's disregarded because the entity below it is consolidated, is treated as part of the upper tier entity. So a lot of this is structuring. I think somebody made the point earlier, one of my colleagues made really the best point, but two different points, but they're the same, is these are very complicated things. There are hair-trigger differences. Having the right advice, having good people like you have here who know these rules well can advise you one way or the other, and it's not one size fits all.
Now let's move on to some of the special challenges for high net worth individuals and family offices. Jim, you started to touch on this before. You want to run with that a little bit further?
Yeah, it's in dealing with the high net worth individuals, it's not always a logical case they lay out of why they want to acquire the aircraft. They want it. And we ask all our clients, why are you getting this airplane? Well, because I can. Because I want it. It fits my lifestyle. Well, we've got to do some tax planning. Have you hired an aircraft CPA to work around the airplane to make sure we keep it all very consistent? No. Do we need to do that? The answer is yes, you should do that. There's all sorts of things, and Nell and I work on a number of different things at times, and it's just awareness for people, and then the people buying the airplanes, and sometimes even their advisors, are not aware of all this nuance that you're hearing about.
Yeah. I couldn't agree more. Family office managers, you got to be proactive. It's hard to tell wealthy, successful people that they need to take a second look at things. There's no question about it. I try to lay it out there, and sometimes they do the same thing to me. They say, look, I just want it. And I say, you can have it. As long as you're not asking me to do something unethical or illegal, I'm going to do it for you. But I want you to understand the difference if you do it this way versus this way. And it's always a balance, right? In practicing law or accounting, it's the complication versus the benefit. And you try to educate people. My line is always, no one pays me enough money to be a bad lawyer. I'm going to lay it out there and then let them make a decision. I've been told to shut up more than one time, though.
Yeah, I still use the phrase, and this applies to this area, that the hangover is commensurate with the size of the party. This is a tax party. And if not treated properly, it's going to hurt. And we're going to start seeing that. So what? 2018 tax returns for high net worth people will be filed in October of 2019. The first round of audits in 2020 and 21. That's where we're going to see the pain. And then the tax rules will probably change with a different administration in Washington.
Yeah. And this is, again, an excellent, excellent point. A lot of the if you're not doing planning, people are going to figure out what they didn't do when they get around to doing tax returns. March 15th, April 15th, or extensions beyond that. They're going to figure out, if we paid more salary out instead of independent contractor 1099 payments, we could have gotten the bigger benefit of that 20% deduction. If we had structured something in a different way in terms of how we flew the plane or how we structured the ownership, we would have gotten a different result. I predict a lot of turnover of accountants and tax lawyers when that happens.
I'd just like to say the biggest thing I see a lot of is people leave tax planning to the end. It's buying the airplane, it's the emotion of buying the airplane, it's the emotion that gets involved in buying the airplane, and then all of a sudden they go, we're 2 weeks out of taking delivery. Did anybody think about tax planning? And we really need to elevate tax planning to the when you've identified an airplane instead of when you're getting ready to place it into service.
Yeah, I just want to answer the last question here. All these images are right off of Google Images. They're there for you and your children, fine. But we're talking about year-end planning. One of my favorite calls is someone who calls and says, we just bought a jet, we need your help with tax planning. You know, that's an oxymoron. There is no post-closing tax planning. Now you're playing, you know, defensive back, and you're just trying to, you know, prevent the bomb from being thrown on you. But we still have some time left, and there are a lot of aircraft that are going to deliver this year. And we've got only a few minutes left. If we just go over some of the you know, the kind of checklist items that we could throw out there for people to consider when they're trying to make sure that a customer who wants to get bonus depreciation this year will get as much as they possibly can this year. How can we save it for them?
Well, I'll back up even and say I will get one phone call this year, probably within the next 2 weeks, that says, I've been talking to a friend who says with the new tax bill,
We all get those, right?
I can depreciate this 100%. I've had a great year economically, so I can use the tax shelter. I've got another friend selling the plane, so I don't need to put it through a pre-buy, because this is the cream puff of the fleet. And then I'm going to charter at 500 hours a year, and I'm going to fly for free. And I get one of those calls every year, and I say to them, I've never seen a business plan that's ever worked like that. And if you've got one, you could make a lot of money selling it, but it's not going to work. And by the way, we won't finance a plane that doesn't go through a pre-buy. So one guy said I had a bad attitude. And called the CEO of the bank, and the CEO said, what's this about? I said, here's what just got laid out. Oh, got it. So it happens.
No?
Well, I know we're talking about federal tax planning, but one of the other things people do not think about is state tax planning. And, you know, all of a sudden they're trying to figure out, oh, well, we were just going to buy the aircraft just outright. And I said, great, pay, you know what, 10%, 9.5% in tax on the purchase price of the aircraft. Oh, no, I'm taking delivery in Oregon. Or then you come back and I said, well, do you have a separate LLC? I'm going to lease it. So, again, from a state tax planning position, great that you can get that whole bonus depreciation, but you can lose it in a heartbeat if you don't do proper state tax planning when you're getting ready to acquire the aircraft.
And the other thing, too, is scripting out the first flights.
Yes.
Very important.
So once you close in a tax-friendly jurisdiction, making sure there's business flights and there's fuel bought in all locations and it doesn't touch certain airspace.
That first flight is so important. You're absolutely spot on. You know, on the issue of, started talking about, oh geez, I lost track of what I was going to say. But, oh, I know what it was. Going forward. So we talked about buying the plane, the write-off, recapture issues, and mindful of that, and policing it, and having good CPA. You know, I do the planning, you know, and the initial planning, and I'm involved with some of the subsequent stuff. But it's really the good CPAs that manage this, either internal or external, that manage this stuff and put together the protocols for it. So it's very important to monitor it. One of the things that's important to look forward at is both in the year of the acquisition, but you can pretty much batten that one down if you do some pre-planning. But going forward, defining what is a commuting expense and what is not a commuting expense. It is still unclear under the existing change in the law how that's going to be interpreted. Commuting from, if you know, your home in Miami or Palm Beach to New York City is a commuting expense. That's not going to be, that flight is not going to be deductible. What is an entertainment expense? What will qualify as a non-entertainment? Because entertainment no longer is deductible. So you have to pre-plan this and think through those flights, because if you dip below 50%, you have recapture. So it's not just the buy, it's the ongoing activity that has to be monitored.
Well, two of the questions that are up on the board kind of relate to our next topic, and probably final, the impact of the Tax Act on financing decisions. And there's a question in there about sale-leaseback. And there's a question about, you know, doesn't the ability to do a tax-oriented lease kind of take away from some of the problems that you have with bonus depreciation? Yes, leasing companies can take advantage of bonus depreciation. They've still got all the same issues about making sure that they've got the tax base to handle it with and the like. So and you presumably will get some of the benefit of the leasing company taking the benefit of bonus depreciation on their tax return passed on back to you in the form of lower rentals. There was a question about sale leasebacks on there. My understanding is that we don't have all the guidance that we're expecting on the bonus depreciation changes, but that the old rules, to the extent they haven't been overturned, still apply. So if there was an opportunity to do a sale leaseback, yes, you could take, you had, I think it was like 90 days to complete a sale leaseback, and then the new lessor could take the bonus depreciation. But if you took the depreciation in 2018 and then try to give it to the lessor in 2019, you're going to have to restate because you've got a sale. So you have to plan around that very carefully. But are we seeing that because of bonus depreciation, there's a change in the way that people are financing? Are they motivated now to do more cash deals, more loan deals, lease deals? How does it impact?
Well, from the high net worth side, we always study the economics on the competing proposals on the true leases. And you can reverse engineer what's the residual they're booking, what are the EBO amounts, and is it really economic? Because most institutions have learned the hard way about some of the positions they took on aircraft from previous years, so they're not going to be that aggressive on the numbers. So this can go either way, and there's a million variations on the theme. I mean, this is the 50 Shades of Gray times 10.
Do we have any questions from the audience, or Alistair, do we have any time to take those, or do we want to?
I apologize, I can't read the screen, so if you have a good question, you can either ask me now or afterwards, but I can't see it from here.
If we don't have questions, I think we can all agree they were the best slides ever for a tax session, and thank you very much to the panel.
Thank you.
Thank you.